Okay. So we started talking about financial statements yesterday. Now we do a separate module on financial business finance elsewhere. Now you should be able to see the slides. Okay. So we do a separate module on finance. Let me just get the list of courses. 1 second. What we do we do business operations, which follows on from business resources. Okay. In terms of the technological use in processes, all that sort of stuff, technological resources, but planning for how we do production, etc. We also do financial awareness, where we go into more detail about the finances and the financial accounting statements and everything else. So we're not going to go into too much detail on it, but we are going to talk a little bit more and look at a few of the numbers and a few of the examples. Yesterday, I picked Unilever, wasn't it? And we looked at the accounts for Unilever. So if you look at any big company, you can get a sense of what's going on by looking at their numbers. The question would be, if we looked at motor companies, what would we see? What decisions would we make? Would they look the same? Would they look different? And that's the benefit of using trading profit and loss and balance sheets. Are the official name now, of course, is income statement and statement of affairs, are what we call the balance sheet. So these statements tell us things. They're standard formats, and the information presented should be a true and fair view of the business. Okay, that's what auditors are for. Not always, but the vast majority of cases, auditors do their jobs, and the accounts that we look at, the trading profit and loss account, the balance sheet, etc., represents what's actually happened in the company and what the company is at on paper. The thing about it is they're always historical looking, they're always backwards, we've already gone past that point when we get the statements, but they are standard. All right. So that's what we're talking about. Now, the reason this is important is that, we're talking about the importance of these, describe the importance of internal and external finances available. We're going to talk about that. Describe the importance of content of financial statements in an organization. The reason these are important is that they help us raise money. They help us manage our ability to acquire funds to do what we need to do. So if we had a business and we want to open a second business, a second unit, so let's say it's a restaurant, we want to open another restaurant, well, it's going to cost us money. So do we save up for it from our profits and do it? That can take quite a while. If we want to move faster because we think there's an opportunity, we have to leverage the situation somehow. We need to borrow money, or we need to seek more investment. To make that case, we need to have our accounts ready. We need to be able to show somebody, here's where we are, here's what's happened. Okay? So, and of course, the other thing about it is that having the accounts, preparing the accounts, gives us, the management of the business, a sense of how well we are not doing. So that's kind of why this is important. Now, we could go down and we could talk about finance and accounting, in depth. That's not the purpose of this level, but there are courses of, so we could go the whole accountancy route. And that's obviously an option as well after your program for you to go. So what are financial statements? We started talking about these things yesterday. We'll go through some technical definitions on these. These are the three big pieces. Trading profit and loss account really tells us whether or not we made a profit. The balance sheet tells us where, how are we currently stacked up in terms of assets versus liabilities. And the cash flow statement shows us where cash flows in the business. That's really important, as we said yesterday, because we looked at the cash circulation system, the where money flows, right, like the blood system. That is probably the most important lesson. If we understand that and we understand the danger of blockages, then a lot of our work has got to be to make sure that cash flows through the system continuously, that we root out blockages, and that we have a potential blockage, that we deal with it PDQ pretty damn quick. Okay, so the other thing we talked about, or I showed you, was something like this. And the idea is that, so some of you will be quite numerical, some of you will be graphical, some of you will be very literal in how you absorb information. I think this is a useful diagram because, like I said, we can picture all of our sales on the blue box. Now, all of our sales has to cover the cost of our sales and give us something towards gross profit. And our gross profit has to cover all of our overheads, all of our non-direct costs of doing business, selling, general and administrative overheads, research and development potentially. There could be other things in there. And what's left after paying those is operating profit. And we pay tax on that profit. So what's left after tax is our net income for the business, the after-tax profits. Okay. Now, for me, I think it's always interesting to look at something like this, as a percentage of this, right? And that gives us a sense of how, in one sense, how profitable our business is or how efficient our business is. But that's not the only way we can look at things. We could also look and say, well, okay, what's our gross profit? If our gross profit is something like this as a proportion of sales, well, what that says to us is that there's quite a high degree of value in the work that we're doing to position our business. So we're doing things beyond the core production that adds a significant amount of value to the business that people are willing to pay for. Okay. And we can sort of test the market side by looking at the gross profit compared to sales on an ongoing basis. If our gross profit against sales is dropping, that means the market is becoming more competitive and we're losing our premium edge. Because in other words, we can't charge as much or we don't have as many sales. Okay. And if that's the situation, if that is the situation, we need to do something about it. If, on the other hand, our gross profit is increasing, that means that, we're probably in a better competitive position. Now, if our gross profit is shrinking, that means we have less headroom to cover off our non-direct expenditure. So what we've seen in the last few months is some redundancies in the tech sector, big companies like Google and Microsoft laying off tens of thousands of workers. So what are they really doing? Are they selling less product? They're not really. Their sales are kind of staying the same. I mean, they're not, well, sorry, there will be some changes, but the sales is not the issue. What they're really doing is they're managing these things here. Some of those salary positions are direct costs of sales. They're staff who are working directly providing supporting services. But depending on the business, it's hard sometimes to tie that into being a direct cost. So some of those software engineers, it's how do you tie them into individual sales? That's kind of difficult. So probably what they're really doing is they're shrinking these things here. So particular sales, their overheads, the general overheads. And in that way, they're creating more operating profit within the business. Okay. Now, will that affect the quality of service down the line? Maybe. Those are all other business decisions. But they're managing their numbers to keep their profits up. All right. And, businesses do that. So I think it's useful to try and picture the business like this. Sometimes it's useful to picture it like this, that this is how the business is kind of structured on a cash basis, okay, or an income basis. This is all the money we bring in. This is where it goes here. This is where it goes there. This is where it goes there. And this is what's left over. And of course, if that bit drops below the line, we have a loss, a net loss, which can happen too. So no matter how we look at it, we need to understand where the blocks are. Ultimately, our accounting comes down to two equations. Assets minus liabilities is equal to capital. And I'll put this one first. Sorry, I beg your pardon. That's not it. Where's the other one? Sorry, that's an example of that. The other equation is, of course, the overall equation is sales minus costs equals to profit. Okay. So we talk about assets minus liabilities is equal to equity or capital. That's the accounting system, and it works on a simple rule that we at the start everything balances. The amount of money we put into the company equals the value of the assets within the company because there are no liabilities. As we start to trade, as long as we do a proper accounting, everything still has to balance. All of the assets minus all of the liabilities has to equal all of the equity or the capital. Okay, that's a standard rule. If that rule holds true, because we do our accounting properly, every time we get a sale, we add it to sales, and if it's a cash sale, we add it to the bank. If it's a credit sale, we add it to sales, and we increase our debtors. Okay, every debit must have an equal and opposite credit. So probably the best way to illustrate this sometimes is to do T accounts. Okay, have you guys done T accounts before? Yeah, you have. Okay, so you kind of know what I'm talking about then, right? Okay, well, I'll just do this very simple example just to illustrate. So when we talk about T accounts, this is effectively how accounting systems work. Okay. One second, I'm just going to align these and center. Okay, there we go. So we have T accounts. So the idea is that our accounting system is based on such accounts. So if we have a bank account in our books, we call it the bank account. And if we have a sales account, if we make cash sales, right, what that means is money comes in. So let's say we start out with a balance in the bank account of let's say we start out with a balance of 1,000, okay, in the bank. All right. So if we make a sale of, and actually, we would have. So if we started our business and we just simply open a bank account, didn't have any assets, and we had, and we just open our business with 1,000 euros of savings, we would open our accounting system like this. We'd have a simple double entry where we'd be saying bank on the capital account. In other words, we've invested capital of 1,000 and it's in the bank account. And the bank account will show we've got 1,000 in the bank and it's a representative of capital. So at this point, our system balances. Everything on this side, all added up, equals the total of all on this side. These are called debits and credits, okay? Every account has a debit side and a credit side. I don't know where the word debit and credit comes from, probably from the Latin, but they mean, what one is, if you want to call it left and right, it's the same idea. All the debits are on the left, all the credits are on the right. There are other ways of doing it, but if we just stick with that for the moment. Now, if we make a sale of, so let's say we're not going to make anything, we're simply selling, let's say we're setting up a babysitting service. So I put 1,000 euros in my bank account, I create a capital of 1,000 and I've 1,000 euros in the bank account. And I'm a high-end babysitter. I sell my babysitting services, I sell my time for 100 euros an evening. So if I make a sale and I do babysitting for the evening, I've earned 100 euros. So how would I show that? Well, what I do is I would put in here, I put in bank 100 euros. I've made a sale of 100 euros and I'm going to add that. There has to be an equal and opposite entry. So I'm going to add that to the bank account. Okay. And I'm going to say sales, 100 euros. Now my business has generated 100 euros in sales, which means we now have 1,100 in the bank. Okay. If I decided to spend some of that money on a social media marketing campaign, let's say I pay somebody 500 euros to make a website, I would take out 500 euros out of the bank, sorry, I would take out 500 euros out of the bank, and what we might call that website. Just start an account for website. Okay, to open it up, to start my business. Okay, and then I might have something like this as the website account. I'm starting to run out of space here, so I'm going to move these things up here. Now, I spent 500 out of my bank account, so I've got 500 here into my website account. So that's actually an asset. So now I know I will have 600 in the bank, 1,100 less 500, I have 600 left in the bank, but I've paid for a website which is worth 500. So I still have 1,100 worth of assets, which allows me to, sorry, I beg your pardon. This is on the right side. This here is on the wrong side. That credit has to equal this debit. Okay, this debit equals this credit equals this debit. And then what we're able to track is what's happening in each account. So my bank account is now worth 600 euro. If I balance it out between the two, I have 1,100 on one side and 500 on the other side. It means that if I cancel things out, I'm going to be left with 600 on this side here. So my business has 600 in cash now, which sounds like it's worse off because I put 1,000 in, but I also have an asset worth 500, which is my website. Okay. And my business has grown in value by the capital of 1,000, which I put into it. Plus, ultimately, this is a profit, right? I would transfer this to the profit and loss account, and the profit at the end of the year gets added to the capital. So my system continuously balances. So when you look at Tesla's accounts, when you look at Ford's accounts, when we look at Unilever's accounts, and we follow every single transaction up. So if you're a local supermarket and you buy a box of toothpaste from Unilever, that purchase starts exactly the same way in Unilever's accounts, and it works its way through all the way to the numbers we looked at yesterday. Okay, there's an awful lot of them added up. So every single transaction is an individual transaction. If we record it correctly, they all add up, the whole system has to work. And that's what we talk about an accounting system. And what we're doing at the end of this process is pulling all of those balances together into a set formula. We're creating a profit and loss account or an income statement. And after we do that, which involves transferring things to the profit and loss account, transferring our wages in, transferring our insurance costs, transferring our rent, transferring our sales, remember they might be on different sides, allowing us to balance off the profit and loss account and showing either a net profit or a net loss for the year. And that's what we're doing. We're creating that figure, whether it's a net profit or a net loss. And at the same time, we're balancing off all of the remaining accounts. So the wages account, for example, might have nothing left in it because while we paid wages, we then transfer it to the profit and loss account. But our website, our debtors, our bank, our creditors, our van accounts, our account which accounts for the furniture in the office, all those balances are transferred into the balance sheet, are recorded as a list effectively. And that's where we create the balance sheet. And that's our system of books, our system of accounts. So the system has to work if we follow some basic rules. Every debit must have an equal and opposite credit. Every credit must have an equal and opposite debit. If every transaction results in a double entry, the system works. Now, in reality, you don't need to worry about these T accounts. We will do an exercise in financial awareness in the next level, But you don't need to worry about doing these things in business normally because we have accounting systems that do it. So if you buy Sage or you use QuickBooks or whatever, once it's set up and you start to put in your transactions as they go along, the system does all of this for you, okay? Because it is just maths, it's just numbers, it's logic. In fact, it's pure logic. The problem arises if you make a mistake. We put the wrong number in or we assign it to the wrong account. But the system still has to balance. Okay, look, that's a very rough and ready introduction to accounts. You know, we can look at it in different ways. Ultimately, the balance sheet is the same as assets minus liabilities equal to capital. So there we go. If we had 10,000 in the bank, we invest 10,000. In this case, we use 3,000 from the bank to buy IT, in which case we reduce our bank by 3,000, but we'd have 3,000 in computers and so on. And every transaction would add to that. So that's how the system works. The performance equation on the other side, which is really what the profit and loss account is we transfer in our sales, and we might have sales from cash sales, from credit sales, sales from this unit, sales from that store, sales from this store. We add them all in. We add in all of our costs on the other side because they've been paid for, and the balance is our profit or our loss. Okay, that's how the accounting system works. Now, it will vary business to business. So in some businesses, we'll have different types of sales. So this is a case we're going to be looking at in financial awareness, where we look at sales and advertising income, and we look at how costs break down in that case as well. In terms of understanding a little bit more, the profit and loss statement is a financial statement that summarizes this revenues, and remember, revenues equal sales, costs and expenses for a period. We normally do it on an annual basis. You can, of course, do it on a weekly or a monthly basis or a quarterly basis. And many big businesses report quarterly. They don't do their full accounts, you know, every quarter. They do their annual accounts once a year, but they give you a quarterly report. They do a public quarterly report to the markets after each quarter, saying, well, here's what happened in the first quarter, here's what happened in the second quarter, and so on. The reason they do that is to keep the markets informed, because what they really want is, they want growth, but they want stability in stable growth in their share prices. These are for the big companies on the markets. For a small private business, we don't report quarterly, but we can do. The point is, the profit and loss account is for a period, and once you've done it for the period, you close it off. Okay. Now, we might add the 4 quarters together to make the annual. That's fine. That's no problem. And that will be filed as the formal accounts, because the formal requirement is annual accounts, not quarterly. It's synonymous with the income statement. Yeah. P&L statement, profit and loss account, income statement, it's the same thing. And it tells us how the company is doing in terms of generating that surplus, that profit. Okay. You see down the end, different people refer to it as the P&L statements, the P&L, the profit income statement, the statement of operations, the statement of financial results, or income and earnings statements. Again, there's lots of different names. It's basically the same thing. It shows us our sales / revenues, all of our costs, arriving at hopefully a profit. Now, if we look at it, so if we look at it, in many ways, it's a measure of our entrepreneurship. It's a measure of how well we're doing in business, okay? Key things, has to include the income, has to include the revenue, right? What is our sales? It includes our expenses. What do we spend money on? Which means it has to show the profit. The sales minus expenses equals the profit. It covers a defined time period. We do it normally for the year, as I said. If we have more revenues than expenses, that means a profit. If we have less revenues than expenses, we have a loss. That's it. That's all it does. So if you look at this information here, what do you think? Is this a profitable business? If you look at this table, is it profitable? I'll tell you what I'll do is we will just do this. I have it here, sorry. We're going to convert this into a profit and loss account. So you've got revenue, purchases, advertising, accounting fees, office wages, drivers' wages, we'll say, research and development and communications. So those are numbers from the business. What does that look like? Well, here we go. So our profit and loss statement for the year, we show our revenue is 100,000. We purchased goods, okay, 34,000, which is there. So take that away and we've got our gross profit of 66,000. Now, we have a number of other non-direct expenses. We've advertising, accountants fees, office wages, and driver, research and development and communications, right? And they're all listed here: communications, research and development, driver, and so on. So those 6 items, that's 11, 23, 33, 45, 40.5, and 42.5. 42,500 is our total expenses. We take that away from our gross profit, giving us our net profit, which is 23,500. And that's a net profit percentage is 23.5% of our sales, which is not bad. So we're showing a net profit percentage of 23.5%. Our gross profit percentage is 66%, which is 66%, which is actually quite good and quite normal, really. So we convert that information very quickly into a profit and loss account, into an income statement. Now we know this business has made, it's reasonably profitable. It's made 23.5% profit on sales. Okay, so that's good. The benefit of this is next year we can look at the same period and we can see, well, did sales go up or did sales go down? And let's say we saw a net profit percentage of 11%. Well, that would seem to indicate that we've done a lot worse. But it depends. So we could have done significantly more revenue at a lower gross profit percentage. So, it would depend. If we jumped our revenue up to $1 million and our purchases grew to 500,000 and our other expenditure was there, and we ended up with profit of 110,000, it's a tenfold increase in sales. Our profit has only gone up 4 times, which is why the net profit percentage would have fallen to 11%. But we'd be making a lot more cash. So there's 2 ways of looking at this. Why do we generate more sales, and could we be more efficient? So there's, the swings and roundabouts. Okay. But the point is that we don't get to get a sense of that until we've got a series of numbers in place. We've got a number of years to look at. The other thing is, if we look at our business and we're showing a 23.5% profit, if we can get the information and we can look at our competitors and they're not as profitable as us, that's a good thing. If we were to look at our competitors and realize, they're doing about the same in sales, but they're making 40,000 in profit, so they're 40% net profit percentage, we'd have to be asking ourselves, what are we doing wrong? So, that's the benefit of having these statements. We can compare against ourselves over time, and we compare against our competitors or other businesses. Okay? The balance sheet is the statement of affairs. Now, the statement of affairs shows us what the business looks like, right, at a particular point in time, normally at the end of the period that we do the profit and loss account. So the profit and loss account is for the year end at this date, and the balance sheet is a statement of affairs at that point in time. So it shows the value at that point in time. It has to balance. If it doesn't balance, we've got a problem in our system. We've got an error somewhere, or multiple errors. And ultimately, assets minus liabilities has to equal to equity. Equity is what the business owes to the owners. So here you'll see a set of numbers, the January figure, the December figure. And what we can see is that cash on hand has gone up by 4,000. What we can see is debtors have gone up by 9,000. Stock has barely moved, which is not a bad thing. Creditors have fallen, which is actually possibly a good thing. And our buildings have gone up by 5,000. So looking at that, we don't know if we made a profit or loss yet, but looking at those numbers, well, what we can see is we've invested in our buildings. So we spent some money on capital stuff. So the 5,000 increase in buildings is a capital investment. It's nothing to do with profitability. Our debtors have gone up, which is a little bit worrying, because it means that more people owe us money. And people owing us money, there's always a danger that they don't pay. So that could be a little bit of a problem. It also means that we've got cash tied up with debtors. So if you think about our cash flow, Remember the blockage system? An increase in debtors is something to watch out for if it's a significant increase. And this is a 250% increase, isn't it? So the debtors at the end of the year is 250% of the debtors at the start of the year. That's a significant thing. We want to keep an eye on that. If it's because of one particular debtor, that's a very key warning sign. On the other hand, our creditors have gone down. What that means is actually, on the one hand, you think it looks good, right? And it means we owe less money. On the other hand, it could mean we're getting less credit. And that means we pay them off. So actually, debtors going up and creditors going down is worse for cash flow. It's worse for cash flow because it means cash is tied up with our debtors are not paying us, and we're paying our creditors earlier, which means we're using cash faster. So that actually could become a problem. Okay, so there's a net swing of, 14,000 there, which is something to watch out for. Remember, if we see debtors going up, yes, it could mean we're doing more business, we're making more sales, but it means we don't have the cash yet. They owe us the money, but we don't have the cash. So it creates a liquidity problem, possibly. Okay? It's the same thing with stock. If stock was to go way up, we'd look good on paper in terms of our assets. But again, we've money tied up in stock. It's not cash. And that means it could be a problem. So those are the things we want to kind of watch out for. So if we were to look at the balance sheet, we could tell from those numbers, we can see the balance sheet at the 31st of December 2018 and the balance sheet at the 31st of December 2019. We can see that buildings have gone up by 5,000. We can see the cash has gone up by 4,000, debt has gone up by 15,000, and so on. So that gives us the picture of the business, okay? If we had capital of 40,000 at the start of the year, and we haven't added to the capital, we still have 40,000 at the end of the year, but we made a profit of 23.5%. That profit belongs to the owners. So it's like the capital, it's treated the same as the capital. And so that's why the balance sheet balances. At the start of the year, it balances at 40,000. At the end of the year, it balances at 63,500 because we've made a profit, and that profit is reflected. Well, where is the profit in the business? If you think about it, 4,000 euro of the profit is invested in, is available in cash. 9,000 is in debtors, 500 is in stock, and another 5,000 is has been used to pay off the current liabilities. Okay, and in reality, what we've done is we've probably taken cash and invested that into the buildings. So when we compare the balance sheet from year to year, that kind of gives us our cash flow statement. So we know we spent money on buildings. We had to have spent money. We have to buy buildings, or certainly that's where value has gone. We know that of the 23,500, 4,000 has been added to the cash, and so on. So you can see, where those things are happening in the numbers. These numbers here are just this one here to here. Sorry. So that's out to. So those ones there, I'm just going to put them in italics bold. Okay, so we're not interested in the bold number, but the other numbers show us where things have actually happened. Okay, so what we see is that we've grown the business, and it's in a better position. But the warning flags for me would be this 9,000 and this, reduction of 5,000. Okay. We just need to watch out for those. So between this 14,000, that's over half of the profit is tied up in less credit we're getting and more credit we're giving. Have I totally lost you? Okay. All right. So that's the, that is, I suppose, a rough introduction. Now, like I said, what that enables us to do is then to go look for money, right? So let's say this was our business, and we said, okay, we've had a good year. We made 23,000 profit, 23,500, but we want to expand the business. So we need money to do that. We need to buy more equipment. We need to buy more stock. We need to, expand our operations, hire more staff. Some of that will be for what we call working capital, which is the ramp-up period. Some of that is for assets. But if we do that, we figure we can grow our revenue from 100,000 to 300,000. So we want money to invest. We need to be clear about what we're trying to achieve. What are we going to do? How are we going to do it? Okay. How much is it going to cost us? And where are we going to get the money from? So I don't know whether I talked to you guys about this story last week. I think it was a different class, actually. There was an Irish jewelry business, and they've just secured 3.75 million in investment. It's a simple enough case. I'll send you the article. They have raised 1 million in debt and 2.75 million in capital for the business. The business is profitable today. We don't know how much profit, but it did revenues of 5 million in the last accounting year. It employs 50 people, so it's got revenue, it's profitable, it employs 50 people, it has a store in Dublin, and they want to expand. So they have raised 3.75 million. As I said, 2.75 million is share capital from a venture fund on the basis that they're going to get a return out of it, obviously, and 1 million is a loan. And what they're going to use that money for, so what do they want to achieve? They want to grow their business. How are they going to do it? They're going to open a new store in London. They're going to enhance their online business model, and they're going to hire new staff. That's basically what they're going to do. So it's going to cost them 3.75 million to do that over time. I'd imagine a chunk of that is opening a new store in London, getting a property, getting a premises, getting it fitted out. That's a big chunk. But hiring staff in London, that's going to be another big chunk. And they're going to need to hire staff and get them trained and ramp them up. So let's say they're going to need to cover, maybe a year's worth of salary. Plus there's going to be back and forth between London. So that's where they're going to spend this money on. Now, their aim is, they know what they want to do is they want to grow their revenue to 40 million. So they're looking for an 8-fold increase in revenue over 5 years to go from 5 million to 40 million. Okay. And they think they can do it because they've been growing their online business. So they're selling more online. So they'll have 2 stores and an online business. And that's where they think they're going to get the revenue. So they've gone out with a business case to do that. Now they've borrowed 1 million from the bank, and probably they've agreed an interest rate on that. Let's say if they borrowed 1 million at 5% for 10 years, that means they've got to come up with 100,000 a year to pay it back, plus 50,000 in interest in the first year, plus 45,000 the second year, and so on. As the principal comes down, the interest goes up. The interest comes down. So, but that means that they, while they borrowed money, they have to be able to generate cash to pay it off. Okay. And the shareholders, the new shareholders who bought into the company, they're probably getting somewhere around 20 to 40% of the business. They will want to see profits for a return for their investment as well. So the business has got a lot of work to do over the next 5 years. So in this case, we know where the money came from. In every other business, you're dealing with potential investors or lenders, which means they have to make decisions. They have to make a decision, should we invest in Shane's business? It could be, should I take a job at that company? If I was a supplier, should I sell to that company? If I'm a purchaser, it should be, should I buy from that company? So I have to make decisions. I want to know that the business I'm investing in or joining or trading with is reputable and reliable. I want to know that I'm not getting myself into trouble. So I need to look at their books to see how well they've been doing. I might look at other stuff to get a sense of who they are, but I want to see their numbers. And what I'm really looking for, what we rely on, is consistency, integrity, and reliability in terms of the accounts. That's why we produce accounts, and that's why we have them checked by accountants and auditors. Let's get that one. We'll come back to that one. If we did want to raise money, then where do we get the money? These are our sources of finance. We look internally. We look at, can we generate it ourselves? We wanted to spend 3 million to develop our business. Do we have 3 million to spend? Have we generated enough cash? Do we have the potential to generate money over time to cover that? So do we get it out of retained profits? Do we get it by having a fire sale in some of our stock to generate some cash? Not a great option, really. Do I look to our owners to put in more money? Are there some assets we can sell? Those are our internal sources of funds. They only get us so far. So we have to look externally. When we look externally for investment, there's two types, debt or equity. The only other type really is government grants, which, you know, from a business point of view, let's not even go there. They can be useful for charities and so on, but the main ways are debt and equity. If we talk about debt, it's a loan, a bank loan. It could be credit, like an overdraft. It could be what we call a debenture, which is like a formal loan document. And the loan is broken into shares, and different people provide a share of the loan to the company. Or equity, we go to look for investors, from an angel investor or a merger with another company or a venture capitalist, or basically it means getting cash from somewhere. We'll skip that one. You know, and it's easy to look at these sources. Actually, that chart should be up here. So when we talk about where do we get money from, these are the sources. They really fall into these internal and external elements. Okay, and when we do that, you know, it gives us the ability to grow our business. Now, how we use the money, how we build our operations, like I said, that's another module. So at this stage, I guess what we want to try and do is pull it together for this module. So I'm going to stop there because we have talked about these points here. We talked about the importance of the documents themselves, and I suppose an introduction to how they work. And the reality is we need them to work so that we can raise funds on the market. So we talk about internal or external sources of finance. So what I'd like to do is just do a very quick run through. Have you guys got any questions? There was a lot in that session. Well, it's the usual sort of format. There's our learning objectives. It's the usual assessment template and document. It should be on Moodle already. This is there's the usual stuff there, right? This is the business resources module. So describe the recruitment documentation. We talked about that. Describe the employability and so on. Task 2 and task 3 and task 4. So there's task 1 is 400 words, 200 words, 200 words, 200 words. So you have 1,000 words in total. So you don't have a huge amount of words to play with, to be honest. Well, like we said, here's a human resource system. It's about getting the right people in place. But really, we're focused on recruitment and selection, which for this module, because the task 1 is describe the recruitment documentation and describe the main employability, personal communication skills. So we're talking about recruitment and selection. Remember, it's 2 processes. Recruitment is about attracting as many people who can do the job, and selection is about selecting from them. Okay, for effective recruitment selection, we need to be clear what we're trying to do, and we need a process. We need a structure and a process. The documents required. Well, if you think about it, we looked at a job description. We looked at a couple of things online. Some of you have a CV, some of you don't. If you haven't got a CV, okay. I'm going to suggest we might do a CV workshop at some point. Okay, it's a thing that grows over time, you know, but it helps when you're applying for a job. So when you're applying for a job, normally for me, it's a cover letter and a CV or a resume and your references. Now, you can do it electronically, of course. We can do it through some sort of portal. That's the way a lot of bigger businesses do it. Or you can send an email with your CV attached. Okay, but what you're really doing is you're expressing an interest in the job and you're explaining who you are and what you can do. On the other side, you're normally doing that in response to a job description and a personal specification. To get to that stage, there's some job analysis has to be done, and the employer needs to understand where we're going and why, etc., and what they're trying to do, and that enables them to describe a job description, a personal specification, to seek applicants. And once you get the applicants, then we're into the interviewing process, etc. So, which is why something like interview questionnaire and candidate scoring sheets actually become important. So if we're going to interview somebody, we probably need to do some thinking beforehand about the questions we want to ask, because what's the information we're looking for, what's really important to us, and we need to be able to track people's answers to that so that we can compare which one is closest to the ideal answer and give them points or whatever we want to score it. So those are the documents that are required. So we can look at never.com. Do we look at that? That might be somewhere we can look at. I look at indeed.com. You can look at, there's lots of job boards available. Just looking online for jobs, you find some of these job boards. We talked a bit about the job analysis process, which leads to that. And again, that'll feature in the module on recruitment and selection. The second task around physical resources, we talked about production lines. We talked about this core inputs, process, or operations outputs piece. And I suppose my view on the predictability and repeatability of that. We gave an example of the leveraging technological resources. And so what you might want to do is pick a business that you were aware of and think about the technological or physical resources required. If it's a distribution business with a warehouse, you need a forklift truck. You need a forklift truck most likely, maybe need a lift. Maybe need a computer scanning system. If it's a dentist business, well, you need one of those chairs to strap your victims into. You need the big, the light they pull down, and you need the thing, the drain where people drool into after they've had their. Anyway, let's not go down the route of dentistry. So there's different examples we can look at for that. We can look at the resources required for different businesses. What are the resources required? Who needs them, and why do they need them? I mean, that's always a useful exercise to do. And in particular, if you talk about spending money, actually looking at that, it's a useful way to try and figure out, do we need to buy these resources or not? Do we need to make this investment? Financial resources. Well, the most important lesson here, which isn't necessarily linked to the assignment brief, is the cash system. This idea of where does money flow, okay? And more importantly, where can we end up with a blockage in the system? Okay. Ultimately, what we're trying to figure out is the sources of funding. What do we and why? What do we want? How are we going to get there? How much is it going to cost? Where are we going to get the money? How much this actually should be, how much will the project cost? So what do we want to achieve? How are we going to do it? How much will it cost us to do that? Where are we going to get the money for the project from? And what is that money? What is that investment going to cost us? How much are we going to have to pay for the money we raise to do that project? Okay. I put another question there as to when do we need it? Well, that's another factor, because, if we figure this project is a €3 million project, we could ask ourselves the question, do we need all the money now? Particularly if it was a loan. We don't need to draw all the money down now. We need to draw it down when we need it, because we don't pay interest on it until we draw it down. So you could take this, do this assignment partially based on, I want to start a business. What do I need? Money, I need skills, I need staff, maybe I need somewhere to work from, I need equipment. Where am I going to get that money? I'm going to rob a bank, I'm going to steal from friends, I'm going to borrow from family. How do I get from investors like Kickstarter and so on? And what are they going to want to know? They're going to want to know around some of our projections, or if I've been in business already, what we've already accomplished. So I'm going to go to some of these sources of finance. There are different sources. So we could look at things like, raising some money internally by rationalizing debtors. Debt factoring has become something recently. It's been around for a while, but it's become more available of in different ways. So let's say we had our existing business before, where we had our debtors of €15,000. If we needed cash in a hurry and we asked them to pay their bill, we still may not get it all, or might not get it all immediately. So one thing that we could do is debt factoring. I don't advocate this. I don't think this is a good idea generally. Debt factoring means saying, Esther owes me money. I'm going to go to Rana and I'm going to say to Rana, look, Esther owes me €10,000. I'll sell her debt to you for €8,000. Rana looks at Esther and thinks, okay, I'm going to be able to get the money from Esther, so I'll do that. I'll give you €8,000 and I'm buying the debt off you. So now Esther, who owed me 10,000, now owes it to Rana. Okay? And Rana's paid €8,000 for that. So Rana's paid at 80%. I've taken a hit, But on the other hand, I now have cash in hand. So that might be how it works. Okay. So that's, again, that's one particular source. I'm going to skip that. We'll come back to it again. Financial statements then, yeah. So what are the story of financial statements? Well, assets minus liabilities equal to capital. That's the core thing. Assets minus liabilities equals to capital. Who uses these statements? People who are going to invest in the business. They want to know how much assets they have. They want to know how much liability you have. And therefore, that's going to tell them how much equity or value is in the business. If you have huge amounts of liabilities, they may be reluctant to invest because they might say, well, actually, there's no real value in this business. Why would we buy into this business? Why would we invest in this business? It doesn't make sense. Or they might, if you were talking about being taken over. So look, we're going to have to close the business down. We decide to go and try and sell the business. We try and get what we can for it. And investors are going to be looking at the numbers and going to be saying, okay, on paper, you might be worth 50,000. I'll give you 30,000 for it. Okay, so that can be part of the negotiation. To do that, we need to have our accounts, our final accounts in place, our statement of income and our income statement and our statement of affairs. And they have to follow the rules. We can't lie. We lie if we fake the accounts. It's a criminal thing. Okay, so we need the accounts, and they become the language upon which decisions are made. Okay. So we talked about trading profit and loss accounts. We had a couple of simple examples. The other thing that these accounts can do is they allow us to consider, how the business is doing, in which case they allow us to look at a lot of different measures. So there's a thing called ratio analysis. Now, we won't be doing this until level 4. This table shows you a bunch of the normal ratios, liquidity ratios, profitability ratios, and so on. Ratios are just an analysis of the numbers in the accounts. The beauty of this is that these are standard ratios. They give us the ability to look at certain things to try and figure out, is the business liquid? Is it profitable? How much debt does it hold in terms of leverage, etc.? So it gives us a template, but we can apply the same template to any business. So actually, if we figure out which are the ones we're really interested in, and we can run it across different years, we can run it across different businesses, we can make our decisions on whether we like this business or not. Okay? All right, so look, we're up against time. So I'm going to leave you with this here, which is just this. Again, I'll give you these slides. These are my notes. All right? Any questions? I know there was a lot in this session, but you have the slides. If you have a particular question, come back to me. This does provide the foundation for financial awareness at level 4. Okay? All right, folks, I will see you in the next module, which is, I think it's Introduction to Marketing, which is a bit more fun. All right? Thank you.